Welcome to episode 36 of Full Throttle, the Presidio Group's automotive industry podcast. I'm your host, Jason Stein, Director of Multimedia and Events at Presidio. On a regular basis, Full Throttle serves as the industry's meeting point for great conversations with leaders across the automotive world.
You know, if you go back to the peak volume year of 2016, there was, roughly about 1 million low price and affordable vehicles. None of those nameplates exist. All of them discontinued. So this isn't an accident that the manufacturers have moved up market. This is to protect the income statement more so than provide a vehicle for every garage because it's affordable for the consumer. So it's really, I feel it's at a kind of critical stage now heading into 2025.
The world in 2025 is set up to be fairly complex, yet somewhat simplistic for the auto industry. Complex in the sense that there are no shortage of issues to solve as we head into another year. EV credits will likely change, potentially altering the trajectory of sales in a short period of time. CAFE regulations may follow suit. There's also the probability of continued adjustments at automaker manufacturing plants, personnel changes, incentives, tariffs, and so it goes. Simplistic? Yes, that too. In a familiar playbook for the industry, there's an inability to drive new vehicle volume back over 16 million units. Affordability leads a host of reasons why, and that leads to overcapacity. What's new is familiar in the auto sector, and that fact will drive much of the decision-making that goes on throughout 2025. And we haven't even talked about Amazon in the auto space yet. So as we prepare to turn the calendar and turn over a new year, why not take stock of all of these issues in one place with one person who watches it more closely than most? Today's guest is Presidio's Director of Research, Kevin Tynan, and he walks us through the complexities of the year to come and the simplicity of what's driving so much of it. Here are about a half dozen items he's keeping an eye on. And cover your eyes, but not your ears. It may not be pretty, but it's reality. With his look at 2025, Kevin Tynan is today's guest, number 36 in our series on Full Throttle.
All right, this is Kevin Tynan, and this is the Presidio Group's podcast, Full Throttle.
Well, it's always great to look ahead, especially when the crystal ball is as clear as the one that Kevin Tynan typically holds in his hand. Welcome in, Kevin. Thanks for being on the program.
It's always my pleasure, Jason.
Let's talk about the year ahead. There are several elements that exist within the marketplace. Number one being the fact that everything revolves around volume, and I'll start there. But I want you to give us a little bit of your glimpse into what's to come, knowing that we are entering a very, I would say, unique but familiar phase of the market, and the fact that the inability to drive new vehicle volume back above 16 million units will now hit the fifth consecutive year in the United States, and that leaves a lot of issues on the table. Can you go ahead and just explain for us maybe where the year starts and what the overriding concern is, especially as it relates to that volume number?
Yeah, and I think what we're seeing, especially since the election, is that I feel like the fundamentals are reverting back to what we saw pre-pandemic, which is not great, right? That's a lot of volume push from the manufacturers in terms of production. And like you said, we're struggling to get above 16 million new vehicle sales in the US. So demand isn't lining up with that, right? Beginning of December, we had 3.3 million units of inventory on the ground, which is, every month is a climb higher. And that's 3.3 is a little bit troubling. I think anything over 3 is a little disconcerting, because when you look at not seasonally adjusted unit sales, we typically are about 1.3 million. So just the quick math of that, 2x would be about a 60-day supply, right? So, at the top of the range, we'll do a 1.5 million unit sales month. So you kind of want inventory at most to be somewhere around 3 million or less, right? And now we're getting a little bit frothy there. But the other thing that started to concern me a little bit more recently, Jason, is that since the election, there's been this optimism, right? That, prices are going to come back down. you look at the stock market, right? Equity valuations are expanding, and I feel like everything is priced in for perfection when there is not perfection in the fundamentals of the auto industry. And I feel like there's a little bit of a disconnect between what the market and maybe even the media and the public is saying about the new administration and where the U.S. auto industry is fundamentally, which is in another oversupplied condition, which is not great.
It's you describe it in some of the things that you've written for the Presidio Group as an intensifying structural cost reckoning, and that's what the industry is facing right now. Product portfolios underpinned with higher priced, wider margin vehicles to maximize profit contribution. Tell me a little bit more about that strategy and what it means overall.
Yeah, and this is a decade plus orchestrated shift by the manufacturers to higher price points, which has essentially meant more pickup trucks, more SUVs, and fewer cars, coupes, and sedans. Right, the revenue and profit contribution trade off there has been the driver of earnings since about 2013. The problem is a lot of those automakers are at the end of that runway, right? Ford has one car left in the portfolio, and there's really no place left to go. So now, if you can't drive your revenue and profit contribution by more units, we're up against that 16 million ceiling. You have no more mix shift left with car versus truck. Yet your costs keep inflating. Everything along the value chain, from raw materials through labor, everything along the way keeps inflating. Now you have to deal with your cost structure, and we're already starting to see that globally. Automakers idling or closing plants, taking out headcount. We've heard Volkswagen, BMW, Nissan, Stellantis issues, right? Management changes, right? They're starting this bubbling up of some activity. And again, I feel like that's very disconnected than the optimism the markets and the media and the consumers seem to be showing heading into 2025. It doesn't align with the structural problems. And the thing is, Jason, that dealing with these issues in the past has always been about sell more, right? They just throw money at the problem, whether it's discounting incentives, and you drive that volume back up, right? We've constantly been in this rebuilding phase since 2009. Volume goes to 10 million. Here we go. We rationalize costs. So now we're building, right? So we're above that break even. The problem now is I don't think that there's that much more real good, profitable organic volume above 16 million. Now you have to deal with the other side of the equation.
And one of the structural issues is capacity utilization. We used to talk about this back in '05, '06, '07, just kind of pre-bankruptcy. One of the alarming things that you have come across is that the stretch of subpar utilization that is, effectively light vehicle factories that are being used is at the second worst now since the data set began in 1972. Well, the longest stretch below 80% in terms of capacity utilization occurred in the 34 consecutive quarters that included the bankruptcy. So for dealers listening, what does that mean?
Yeah, that's a really scary stat that I stumbled upon. 80 is really kind of ideal, right? It's where you want to be. It gives you a little bit of flexibility to increase production, but too you're not too high where everything's overtime and it gets expensive, right? But that data set, actually, if you're looking at 80 as the target, those quarters are that I looked at are under 75%, right? So we've been under 75% for, I think it's something out of 19 out of 20 or 20 out of 21 of the last quarters. And that stretch was like 34 out of 35 during the bankruptcy period. So it's troubling that capacity is so low. And again, when you think about that mix shift to more expensive vehicles, you are going to sell fewer of them. So if we've been building capacity over the decades, but on the other side of it, we've been increasing price point, and transaction prices. Well, now you just have too much capacity on the ground. And I feel like we're at that point where this has to be dealt with. And again, it's not being dealt with more volume. It's not a 17 million unit market or an 18 million unit market. If it's a 16 million unit market, yet it's sized for 17 and a half or 18, at some point that has to be dealt with. And you're either going to do that by increasing volume and throwing money at it, or you're going to address your structural cost side and take some of that capacity and headcount out. And what I've been saying, Jason, like, even the idea of rolling it back and saying like, okay, look, Ford's 98, 99% truck. Let's just back off that, bring pricing down a little bit, utilize those vehicles don't exist anymore. They're not in the product portfolio, right? Cars have been discontinued. If you go back to the peak volume year of 2016, there was, roughly about 1 million low price and affordable vehicles. None of those nameplates exist. All of them discontinued. So this isn't an accident that the manufacturers have moved up market. This is to protect the income statement more so than provide a vehicle for every garage because it's affordable for the consumer. So it's really, I feel it's at a kind of critical stage now heading into 2025.
2025 will have a lot of talk around eliminating the Inflation Reduction Act's $7,500 federal tax credit for consumers purchasing battery electric vehicles. How is that going to affect the market, and how is it related to possible CAFE changes too?
Yeah, I think that's the key, right? Is that if the government's gonna pull this sort of demand creation lever back and say we're not going to do that, right? Because that's what arguably the $7,500 tax credit is going to do, is create demand. Ideally, you could argue that it gives the manufacturer the ability to raise prices by 7,500 and get that kind of as a pass through. But let's assume the goal was to create demand. You can't take that demand lever away from the consumer, but hold the manufacturers to the same standard, right, of corporate average fuel economy or emissions reduction, right? Because you're saying, well, you're making us sell these things, but now you've taken away the incentive for the consumer to buy them. You're only hurting your manufacturing base. So I feel like those two things, the California Air Resources Board, like, excuse me, some of these penalties, you can't take demand away, yet keep the manufacturers beholden to those targets. So to me, that's the interesting side of it. What does the government do to relieve the pressure on the manufacturers to sell things that have not been profitable for them? Now, if you do both sides of that equation, you come back and it's a little bit more of a free market, which says, hey, if you want to sell expensive trucks all day long because that's where you make your money and the market turns, that's on you, right? But we're not forcing you to sell electrification or affordable vehicles or anything. And I feel like that's kind of what happened in the 2009 bankruptcy period, is that automakers were already pushing up to more truck, and it was a very different era in terms of full frame platforms and low MPG. And so when gas prices spiked, there was really nothing for the manufacturers to do. But their argument was, well, if you didn't make us hit this corporate average fuel economy target, we would have been okay. And maybe that's where the government comes in, and there's bailouts and there's money. So, everything's kind of related here. But I think, to your initial point, is you can't do one without the other. You can't take the consumer incentive away, but not change the mandate for the manufacturer.
Kevin, one of the other themes that we're going to look at in 2025 will be focused around the allure of the pre-owned vehicle segment. What happens to pre-owned cars next year?
Yeah, I think that's one of the opportunities for the retailers, the two of them being fixed ops, and the other, that one would be first, but then used vehicles probably cycles back into favor a little bit after that. The problem, because the new vehicle margin compression is happening and will continue to happen. So that to me is the beauty of the full line franchise dealer business model is, hey, the new vehicle market's margins compressing a little bit. Let's go do more of this fixed up. Let's go do more used vehicles. problem with used vehicles is that because of the higher transaction prices, and this is just one component of the used vehicle markets, but it's an important one, is there's been no incentives, right? So when supply and demand were in balance, you had manufacturers back off incentive spending because essentially it's throwing good money after bad. Prices were firm; they were above MSRP in a lot of cases, and within that basket of incentives, you lost leasing, right? Which is a very robust and important supplier of the used vehicle market 3 years down the road, right? I typically look at what's leased today comes back as most likely a certified pre-owned vehicle or at least late model, low mileage 36 months from now. The problem is that when you have a low total volume, 13 million units, 14 million units, and you had lease penetration go from 30% plus before the pandemic to the teens during, now your off lease market is very, very undersupplied, and it actually stays that way through next year, 2026. 25 is the bottom. And what I mean there is that pre-pandemic, we would get on a rolling basis 5 million off lease vehicles. And that would feed the certified pre-owned, which was very helpful for the franchise dealers. Because of that low volume and low leasing, that number goes from 5 million down to 2.4 million. It's cut in half. And 2025 is the year that happens. So while I like the used vehicle market, and you look at Carvana and CarMax have fought through and been successful through the period, I think that maybe within another 12, 18 months, we're going to start to see the full line dealers kind of get back into that as another valuable revenue and profit source.
Final question is on Amazon. A lot of
Yeah.
consternation, a lot of hand wringing, a lot of unknown, many unknowns around Amazon and the rollout that's going on. And now the rollout should be sorted through 2025 after a bit of a stall. What do you see? How does that affect dealers? How does it change the industry? Probably more than anything else.
Yeah, look, at this point, for what I at least have read and know, I think it's an absolutely great opportunity for the franchise dealer base. What that hinges on, however, is, and I've heard these rumblings, and I don't necessarily see it, but I'm not there every day. Now, if Amazon is in this business to be a marketplace between the dealer, who also looks at the manufacturer, and the consumer, right in the middle. If this is a marketplace between the retailer and the consumer, then it's an opportunity of a lifetime, I think, for the industry, right? Because now you have a digitization of new and used vehicle sales that the industry has really kind of been fighting, and has been one of the key components that has made Carvana successful, right? Is this idea that Carvana is not a marketplace because they own the inventory, but they've sort of proven out the idea that people will buy big ticket discretionary items without seeing and touching them, in person. So the idea that, like, oh no, people want to be on the lot and want to deal with a salesperson, Carvana's proved that it can be done a different way. And I think what this marketplace does is it takes that a step further. Now you have a name like Amazon backing this marketplace, 300 million, whatever the number is, shoppers go there, deal with it every day. And I think if Amazon can take the parts of the process for the dealer that are difficult, that the consumer doesn't like, and don't even make them a great amount of margin, and say, hey, we'll handle that process for you, the shopping process, the buying process, the financing process, scheduling, we'll do all that. And it may sound like you become an order taker, but that you sit there and you get an order come in and you handle the delivery, right? So now all that difficult part of the process that can earn you 5% gross, and falling, is not your responsibility anymore, right? You're still getting paid for the vehicle because you own the inventory. But I think it just creates a digitization that Amazon is going to be way better at than the franchise dealer base. Now, the problem becomes if Amazon is using this as the first step to get into direct sales, which I think is the fear. I don't see that, right? In fact, I look at this like as long as that franchise model and Amazon is creating the marketplace between the retailer and the consumer, the benefit to the manufacturer is simply that the retail channel is happy and healthy and transparent and liquid, and it helps them maintain their manufacturing and their output, which is what they are, right? They are manufacturers. They're not retailers, and I don't think they would be very good retailers either. So to me, this marketplace is really about bringing together the retailer and the consumer. This isn't about the manufacturer. To me, they get a secondary benefit from this of a good, finally competitive and digital retail marketplace that's dealers partnered with the biggest retail or e-commerce retail name in the business. To me, it seems like it's game changing as a positive for the retailer, right? And you still do your daily business on the lot and orders come in and you're the one that makes the consumer happy because you deliver that vehicle to them. None of the fighting in between, right? That's on Amazon, and you deliver the vehicles and you move on to the next one. And I think it can be a big deal. It's going to be a long road, right? You got to bring manufacturers on board. You got to bring the dealers on board. You got to have them put inventory up. But I think this is a net positive as I see it for right now.
Always so good to talk to our friend Kevin Tynan and give us a bit of a lay of the land on 2025 and lots to think about as we go into what will not be a dull year. Kevin, thank you so much for being with us here on Full Throttle.
My pleasure, and happy holidays, Jason.
Thank you. Same to you. That's the 36th episode of Full Throttle, and a special thanks to my guest, Kevin Tynan of the Presidio Group. Thank you for listening. For a library of all of these episodes with industry leaders, go to thepresidiogroup.com. I'm your host, Jason Stein. We'll talk to you again next time.